Do you really think that the Federal Reserve can stop supporting these markets? Because when they do, or when they lose control, or when they choose to lose control, this house of cards implodes. It is just that simple. If they do not keep doing this and buying up all of those assets, it all implodes. It is a Ponzi scheme, no doubt about it, and it cannot go on forever. It never does. I mean, it's not like it hasn't been tried time and time and time again. Because the reality is the Fed has lost its credibility. Do you still trust this? Because there's virtually no purchasing power left in it. And world growth, that whole big punch bowl has been built on that cheap debt. And I betcha, think about this, right? A component of growth is inflation, all right? That's how they can make things look better and debt to GDP and all that kind of garbage. But what this means is that the world is making less money. That means it's making less money to service all of the debts that it has. We can't use the word stagflation, where it's inflation and slowing earnings, but that's exactly what's been happening. And we even talked about this a while ago before anybody else started using the term stagflation. In 2022, there are now 43 countries that are at high risk for debt distress and 13 countries that are in debt distress. Now, what are you going to do about that? This is significant, and it could topple the whole globe quite easily. This debt for emerging markets was 20% of GDP, and now it's at 28% of GDP. This is not a big shock that this debt has grown, but where it used to be issued by traditional global lenders, and these would be like the Paris Club, the World Bank, the multilateral, so the World Bank, the IMF, that realm. And remember, taxpayers are responsible for any debt that the governments take on or take on behalf of the taxpayer, even if it's to bail someone out. But the new global lenders that have really come up are China and with the Euro bonds, with Euro. So you have a different, there's a different attitude about it as well. And it puts this debt in greater risk because a lot of this, especially in the Euro bonds, that's private. And they have not been able to get the private corporations to restructure this debt as easily as they could get governments to do it, because after all, governments are playing with other people's money. What do they care? Let's just restructure it. It's not that simple, really. The boom in hidden debts have given way to a rise in the number of unrecorded debt restructuring. This is a reset. A restructuring is a reset. They are changing and resetting the terms of the agreement. U.S. government bonds, we all know this. I hope we all know this. If you don't, U.S. government bonds are the foundation of the global markets. And they've been acting a little wonky because vanishing Treasury market liquidity faces a new $3 trillion test because presumably the Federal Reserve is going to run off that balance sheet, which they tried to do before. And, they were able to do it for a little bit, raise rates, run off the balance sheet, but it ended up in a big fat fail. And that became apparent in September of 2019. And then, we lurched from that September 2019 crisis into another crisis that really became apparent in March of 2020. But this is a huge problem. And as interest rates right? If they're going to start selling off those bonds and increase interest rates, well, guess what happens? Fragile U.S. Treasury liquidity today may be exacerbated by the supply shift in coming months, especially after the Fed starts quantitative tightening. In other words, letting that balance sheet run off. Personally, and we're going to look at that in a little bit, personally, I don't think they will do it. I think they're going to try because they have to. For their credibility, they're going to try. So you're going to have the central bank get rid of $3 trillion in debt and the government issue another God knows how many trillions in debt. And who's going to absorb this? I mean, that's really what the problem is. That's why the Fed had to step in as lender of last resort and buy all of these treasury bonds as well as all of the mortgage-backed securities, which we're not talking about that today, but they had to buy all of these because there was no liquidity. There wasn't enough buyers in the market. Faltering market liquidity renews prodding for treasury buybacks because we gotta do something. The central bank has to create that liquidity. There are not enough buyers of our government debt out there. That started in 2002. This is not new. It's just been escalating. And you can get away with bad behavior especially if you can create money out of thin air, for a lot longer than anybody would think possible, but not permanently. And I think the shift is definitely, it is. The shift is definitely on us right now. The same kind of switch is going to happen again. But this time they want to take us from a debt-backed system, keep us on a debt-backed system, but just take it digital. Gives them more control, helps them create that liquidity. Restructurings with private external creditors, which would be bondholders. So if you have a mutual fund, maybe in your retirement plan or something like that, whether you realize it or not, you could very well be owning some of this debt. Now, we have to deal with this debt binge. Now we have to deal with it. And I don't know how we're going to deal with it. Reset all of it? Because I'm going to strongly encourage you to become your own central banker and hold the cure for all of this debt, which is savings. If you have enough savings and you run into a little problem, doesn't really matter. You can weather that storm. If you have no savings and you run into a problem, most Americans can't come up with $400 in an emergency.